what's happened, in 2006, the government started changing the mortgage rules. And where this sort of came from was the United States of America. And I'm just gonna sort of go off here a little bit here. First and foremost, we're never gonna be in the same mortgage crisis that the US happened, okay? I traveled down to the US, I've been in the business for over 20 years. And I traveled down in 2005, 2004. The mortgages they had there were truly no income, no documentation, no job, you have a mortgage. They were truly, that's why they had the whole mess that they had and when the financial crisis did happen, with them bundling it up. In Canada, we've never had no doc, none of that type of mortgage financing. Everybody was qualified based on the guidelines that were set out. But at this point in time is when we saw the zero down program introduced in 2006. People were starting to introduce longer amortizations. We could do 30, 35, 40-year amortizations. Obviously in 2008, we don't need to go back, but it was very much the financial crisis happened, all related to the bundle up and packaging and selling off of mortgage securities that the US banks thought was a great idea. As we've proven, it was not a great idea. So, and it was we're still feeling the effects of that today. So what's happened is, in 2008, the first rule changes were zero down was gone. So right away, we only had zero down payment for approximately really 18 months in Canada that we had zero down. The US had zero down for about 4.5 years. So you can just imagine, of course, they have 10 times the amount of population as we do, why they got in so much trouble, okay? So just to give you background. They also increased the minimum beacon score to 620, which is your credit score, which we talked about, and the new loan documentation requirement standards. They also reduced the total debt service ratio. A total debt service ratio is your mortgage payment, property taxes, heat, and if you owe credit cards, lines of credit, which hopefully you don't, but if you do owe that, you can go to a maximum of 45% of your gross monthly income. That was the rule changes at that particular time. The 40-year amortization was also reduced to 35 years. So fast forward, that was 2008, went along, we came into 2010. In 2010, we had another rule change. And basically the qualifying rate, which is still into effect at this point in time, the Bank of Canada set a qualifying rate which is right now at 5.24%. If you want to take any mortgage term other than a 5-year closed term or longer, so if you want to take a variable rate, 4-year, 3-year, 2-year, 1-year, if you are insured, which is putting less than 20% of the purchase price down, you are required to qualify at 5.24% to take a lower term. So it does lessen your affordability rate. Not sure why they have a 5.24 qualifying rate. We haven't seen it in 6 years, but that's their qualifying guideline rate. Now, if you have 20% down, the rules are completely different, because now you're what's called a conventional mortgage, and you're able to qualify depending on what each lender's guidelines and policies are, and every lender has their own set of rules and guidelines and policies. So rental properties were also reduced from 20% down payment from 5%. So anyone who took advantage of that was very good. And in 2011, which they had another set of rule changes, the 35-year amortization was now gone. It was now reduced to 30 years. Refinancing, you could refinance before up to 90% of the value of your house. Now you can only do up to 85. And the elimination of secured lines of credits, because you could actually get lines of credit in 2000 up to 2011, up to 85% of the value of your home, if they were insured through Canadian Mortgage and Housing Corporation. So fast forward to last year, and last year was really where all the major rule changes and sort of where we put ourselves into now in the mortgage world. You can no longer buy a home, which of course we call this the Vancouver rule, because there's nowhere else in Canada you can buy a house over $1 million on that side, but it's called, you can only buy a home up to 5% down, up to $1 million. And just for the trivia there is, do you think it's actually $1 million? It's no, it's $999,999.99. It can't actually be $1 million. We've actually had that turned down by CMHC. So it's actually under $1 million. So they also reduced refinances up to 80% of the value again. So they reduced that back, so you can no longer have refinancing of your home to a max of 80%. This is probably the single biggest impact, I would say, that's happened in the mortgage world, is because due to the low interest rates, as Stacey's mentioned, a lot of people do have equity due to the house prices that come up, and they are paying 12 to 15% on credit card debts or longer term debt. And it does make sense to refinance it, especially at a lower interest rate when we're below 3% right now. And we can't do that because we can't go above 80% of the value of the people's property, even if they have good credit and they debt service within the guidelines. So that would be the single biggest impact. They've also taken down the gross debt servicing ratio from 44 to 39%. So they made it a little bit more less that you can have for your outside debt. And again, the 5.24 for if you're less than a 5-year fixed rate currently. So this is where we are. Now the B20 guidelines, we'll just go back to explain on that one. The B20 guidelines came into effect November 1st of 2012. Now the B20 guidelines are what set out, was sort of the aftermath of the financial crisis. And at this particular time, it's worldwide. What they're trying to do is set up a guideline standards for underwriting, for paperwork, and so what you're required, so each lender now has their own set of rules and their own set of guidelines that they're trying to follow, which is a national standard. So there's definitely more paperwork required. And of course, Canadian lenders have been very good. Our defaults are very low across Canada, and they've always dotted the I's across the T's. But what is happening now in the mortgage world is we're triple checking, dotting the I's, and triple checking, dotting crossing the T's. So it's quite paramount that your paperwork is very up to date, and of course is good. You have the financing. So that's where we are, and where we're at today's market.